This is the most common financial advice given to anyone trying to build wealth. Start investing as soon as possible. Put in whatever you can, even if it's just a small amount. Time in the market beats timing the market. Compound interest is the eighth wonder of the world. All of that is true, and for most people in most situations, it's the right advice. But here's what that advice assumes. Investing is the highest return use of your capital. At scale, that's true. At the scale most people start with, it isn't. $10,000 invested in total market index funds at 8% annual returns produces $66 per month. Not $6,600. $66. That's not a meaningful income stream. It's the beginning of a wealth trajectory that takes decades to produce meaningful monthly income. That same $10,000 worth of time and energy invested in building a digital content business, building phases 1 through 5 of this portfolio, can produce $2,000 to $5,000 per month within 2 to 3 years. Build the income first, then invest the surplus at scale. Then both compound simultaneously. That's phase 6, and it's the reason it comes last. Here are 3 reasons why phase 6 comes after phases 1 through 5. Each one matters. Together, they make the sequence the only one that works. Reason 1, you need surplus capital to invest. Investing requires money you don't need this month, not money you might need, money you definitely don't need for at least 5 to 10 years, because market volatility, in the short term, can reduce portfolio value. And you need to stay invested through those reductions for the compounding to work. Phases 1 through 5 create the surplus. Phase 6 deploys it. Reason 2, at small capital scale, building outperforms investing. At $10,000 invested at 8%, $800 a year, $66 per month. That same $10,000 worth of time spent building a niche YouTube channel, a digital product, and an email list that generates $2,000 per month has a return that's not comparable on a percentage basis. The building wins decisively at small scale. As the investment portfolio grows, $50,000, $100,000, $250,000, the return on invested capital becomes genuinely meaningful. But it starts from a small capital base that grows through consistent monthly contributions from the income the business generates. Reason 3, consistent investing requires consistent income. Dollar cost averaging, investing a fixed amount every month regardless of market conditions, is the most effective and emotionally manageable investment strategy available to most investors. It removes the timing decision. It forces buying at highs and lows. Over time, it produces a lower average cost per share than trying to time purchases. But dollar cost averaging only works when the monthly contribution is guaranteed. An inconsistent income means inconsistent contributions, and inconsistent contributions mean the compounding math never has the continuous input it needs to build. Phase 5's income floor, the membership MRR, is the predictable income that makes consistent monthly investment contributions possible for the first time. Here's the mental model that makes phase 6 make sense. Phases 1 through 5 are an income machine. They generate cash flow through attention, audience, products, affiliate recommendations, and a recurring membership. The income machine requires your involvement, diminishing over time as the business matures, but never entirely absent. Phase 6 is a wealth machine. It takes the surplus output of the income machine and deploys it into assets that compound entirely independently of your involvement. A well-constructed investment portfolio grows whether you publish content this month or not. The income machine and the wealth machine are not in competition. They work in sequence and then in parallel. During phases 1 through 5, all available resources go into building the income machine. No meaningful investment because the capital is more productive building the business. At phase 6, the income machine is generating consistent surplus. A portion of that surplus, not all of it, not most of it, but a consistent portion, flows into the wealth machine every month, automatically. 5 years into phase 6, the wealth machine is generating its own monthly income from dividends, interest, and portfolio appreciation. That income adds to the income machine's output. Now, both machines are running simultaneously. The compounding from both sources accelerates. 10 years into Phase 6, the wealth machine may be generating more monthly income than several of the earlier phases combined. Not because you did anything dramatic, because the consistent monthly contribution over a long enough time horizon produces an outcome that feels disproportionate to the effort. That's compound interest working at scale. Here's the math, not rounded or simplified for effect, the actual numbers. You invest $1,500 per month every month, automatically, into a low-cost total market index fund, returning 8% annually on average, which is the long-run historical average return for a diversified U.S. equity portfolio. Year 1, you've contributed $18,000. Your portfolio value is approximately $19,440. Your monthly return from portfolio appreciation is $130. That number, $130, is underwhelming. I want you to remember it, because the contrast with what comes later is the entire argument for starting early and staying consistent. Year 5, you've contributed $90,000. Your portfolio value is approximately $113,900. Monthly return is $759. Year 10, $180,000 contributed. Portfolio value, $278,000. Monthly return, $1,853. Year 15, $275,000 contributed. Portfolio value, $524,000. Monthly return, $3,493. Year 20, $360,000 contributed. Portfolio value, $889,000. Monthly return, $5,927. Year 25, $450,000 contributed across 25 years. Portfolio value, $1,430,000. Monthly return from portfolio appreciation, $9,533. Here's what happened between year 1 and year 25. You did not make more aggressive investment choices. You did not get lucky with individual stocks. You did not time the market. You invested $1,500 every month in a broad market indexed fund, and you left it alone. The math did the rest. $9,533 per month in year 25 from a standing order you set up once. This is what Phase 6 produces at the end of a long enough runway. Step 1. Build the financial foundation before you invest $1 in the market. 3 layers in order. Do not move to the next layer until the current one is complete. Layer 1, emergency reserve. 3 to 6 months of personal and business expenses held in a high-yield savings account. Not invested. Liquid. Available within 2 to 3 business days. This reserve exists to ensure that a slow business month, an unexpected expense, or personal emergency never forces you to sell investments before they've had time to work. Forced selling is the most common way investors underperform the market average. The emergency reserve prevents it. Layer 2, employer retirement match. If your business operates alongside employment that offers a retirement match, capture it entirely before investing elsewhere. An employer matching 50% of contributions up to 6% of salary is a 50% instant return. No investment in the world matches it. If you're self-employed with no employer match, open a solo 401k or SEP IRA for the tax advantages before investing in a taxable brokerage. The tax deferral compounds over decades and is one of the most impactful financial decisions an independent creator can make. Layer 3, open a taxable brokerage account. Fidelity, Schwab, or Vanguard. All 3 are low cost, established, and have no trading fees on ETF purchases. This is where Phase 6 compounding lives. Step 2, automate every part of the investment process. The reason automation is the strategy, not just the execution method, is this. Behavioral finance research consistently shows that investors who make active monthly decisions about whether to invest, how much to invest, and what to invest in significantly underperform investors who automate a fixed monthly contribution into a broad index fund and leave it alone. The decision fatigue of monthly investing creates hesitation. The market goes down in October. You wonder if November is a better time to invest. December comes. You haven't invested since September. 3 months of contributions missed. 3 months of compounding lost. Automation removes the decision entirely. On the 15th of every month, $1,500 moves from your business checking account to your brokerage account and automatically purchases the index fund you've selected. Market up, market down, news cycle loud or quiet, the purchase happens. This dollar cost averaging, buying a fixed dollar amount on an investment on a fixed schedule. When the market is up, your fixed dollar amount buys fewer shares. When the market is down, it buys more. Over time, the average cost per share is lower than if you tried to time purchases. Set the amount you can invest consistently. Not the maximum you could theoretically afford in a good month. The amount you can move every single month without it creating any constraint on the business or personal finances. Start there. Increase it as Phase 5 income floor rises. One standing order, one fund. Set it up once, update the amount annually. Step 3, the portfolio construction sequence. Start with one fund, not a diversified portfolio of 7 holdings, one fund. VTI, the Vanguard Total Market ETF, holds over 3,600 US companies in a single purchase. Every sector, every market cap, every region of the American economy. The expense ratio is 0.03% annually. 3 cents per $100 invested per year. This is the most efficient exposure to US market returns available. If you're using Fidelity, the functional equivalent is FSKAX, the Fidelity Total Market Index Fund. The expense ratio is 0.015%, identical exposure. Either one is correct. Hold VTI or FSKAX as your core and only holding until your portfolio reaches $50,000. No stock picking, no sector ETFs, no individual company positions, one fund. At $50,000, add VXUS, the Vanguard Total International Stock Market ETF. This gives you exposure to developed and emerging international markets. US and international markets don't always move together, and adding international exposure at this portfolio size reduces concentration risk meaningfully. As the portfolio grows beyond $100,000, begin adding a dividend income layer. SCHD, the Schwab US Dividend Equity ETF. It holds high-quality US dividend-paying companies. VYM, the Vanguard High Dividend Yield ETF, is a comparable alternative. At portfolio sizes above $200,000, consider adding BND, the Vanguard Total Bond Market ETF, as a stability layer. Bonds reduce portfolio volatility and provide capital to rebalance into equities during market downturns. This is not complicated. It's deliberately not complicated. Complexity in investment portfolios almost always reduces returns. Simplicity, consistency, and low cost almost always improve them. Let me show you the complete system. Phase 1, you build attention. Every video published, every article written, every piece of content that reaches someone who didn't know you existed. Organic traffic that grows quietly and compounds. Phase 1 produces the raw material that makes every other phase possible. Phase 2, you own the audience. The email list moves the relationship from a platform you don't control to an asset you own outright. The list grows with every new subscriber, and it earns a conversion rate no social platform can match. Phase 2 produces the owned channel that makes Phase 3 viable. Phase 3, you launch your first product, the proof of concept sale. The moment the portfolio becomes commercial, the product earns while you sleep. Phase 3 produces the buyer list that makes Phase 4 and 5 more effective. Phase 4, you layer affiliate income. The trust built in Phases 1 and 2 converts into recurring monthly commissions from tools and platforms you've already recommended. Phase 4 produces passive income that compounds from past work without requiring proportional new output. Phase 5, you launch the membership, the income floor, the first stream that doesn't reset to zero on the first of every month. Phase 5 produces the predictable surplus that makes Phase 6 possible. Phase 6, You invest that surplus. The income machine funds the wealth machine. Month after month, automatically a portion of the surplus moves into a broad market index portfolio. The portfolio grows. The monthly return from the portfolio grows. Eventually, the portfolio is generating meaningful monthly income independent of anything the business does. Both machines running simultaneously. The business compounds. The portfolio compounds. They feed each other. That is the digital asset portfolio. That is what the compounding starts now means. Here's your weekend challenge for Phase 6. Number 1, calculate your emergency reserve target, 3 to 6 months of personal and business expenses. Write down the number. Number 2, open a high-yield savings account if you don't have one. Fund it with your first month's emergency reserve contribution. Step 3, confirm you're capturing your full employer retirement match. If self-employed, research solo 401k or SEP IRA. Number 4, open a brokerage account, Fidelity, Schwab, or Vanguard. They're free to open and free to use. Number 5, set up your first automatic investment. Whatever amount is consistent right now, set the standing order. 5 actions. Some of them take an afternoon, others you may have already done. The ones you haven't done are worth doing this weekend because Phase 6 is the one phase where starting later has a mathematically significant cost. 10 years from now, the person who started their automated monthly investment this weekend will have a meaningfully different portfolio than the person who waited 6 months to get around to it. Compound interest doesn't punish hesitation dramatically in the first year. It does in year 10 and dramatically in year 20. Here's what I want to say as we close this series. When we started, in part 1, the question was why the digital asset portfolio was the right model. In part 2, the question was how to build it. In phases 1 through 6, the question was what to do in each phase, in what order, with what tools, and toward what milestones. Those questions are now answered. What's left is yours, the channel you build, the email list you grow, the first product you ship, the affiliate programs you apply to, the membership you launch, the standing investment order you set up. None of it compounded while we talked about it. It compounds when you build it. If you watched this series and you're ready to start with Phase 1. One platform, one niche, one piece of content this weekend. If you've been building while watching, the next phase is already clear. You know what it is. Do the work. And if you're coming back to this series months or years from now after having built something real, drop it in the comments. What phase are you in? What's the income floor? What's the portfolio value? Those comments are going to be the proof that this system works, and they're the best thing I could read. This is Evergreen Income. The compounding starts now.